So for this lecture, we're going to start talking a little bit about capital structure. We can think about a very simple equation, which is that the value of a firm just equals the value of its debt plus the value of its equity. And we want to think about, well, how does the structure of the firm impact its value? So let's imagine that we started with an unlevered firm which is all equity. So we're going to have 6,000 shares in this firm. The stock price is going to be 50, which means it has a total equity value of 300,000. It doesn't have any debt, so its total firm value is going to be 300,000. And the debt to equity ratio is going to be 0. So let's think about how we can go from an unlevered firm into a levered firm. Well, let's suppose that the firm wants to transfer 100,000 of its value from equity to debt. So how would it do this? Well, it could do this if it were to borrow $100,000 and then use that money to buy back shares. So it's taking 100,000 in debt and reducing its equity by 100,000. So it's transferring 100,000 from equity to debt. And so how many shares would it be able to buy back with $100,000? It would be able to buy back 6,000 shares. So there would be 4,000 shares outstanding. But the firm value, the total value of the firm, would not be affected by this change in capital structure. The debt to equity ratio would just change because now there is 100,000 in debt and 200,000 in equity. So we have a debt to equity ratio of 0.5. Now let's think about how the capital structure will affect the payoffs to the firm's investors. So let's imagine that the firm had cash flows of 36,000. So both the unlevered and levered firm are going to have the same cash flow of 36,000. And let's imagine that the firm has an interest rate of 10% on its debt. So in terms of interest payments, the unlevered firm doesn't have any debt, so it doesn't have to pay any interest. The levered firm has to pay 10,000 in interest, right? Because it had 10,000 in debt and an interest rate of 10%. And so the unlevered firm has 36,000 to pay out in dividends. And if you recall, it had 6,000 shares outstanding. So per share, it has a dividend of 6. With a stock price of 50, this means the return to shareholders is 12%. For the levered firm, because it has to pay out this 10,000 in interest first, there's only 26,000 left over for shareholders, but there's only 4,000 shares outstanding, which means that each share receives 6.5. This means that the return is actually higher in the levered firm. So this creates a little bit of an interesting question, right? Why is it that the dividend yield is higher when the firm is more highly levered? So when we compare the unlevered firm to the levered firm, the equity in the unlevered firm had a return of 12%, but the equity in the levered firm actually had a return of 13%. So this is a question that we might want to ask, which is that would investors prefer a certain kind of capital structure in order to get a higher return? Is it possible that, for example, a shareholder may prefer that a firm borrow more so that the return on equity would be higher? So let's look at a case where I have a shareholder who owns 30 shares of stock. In the unlevered firm, these would be worth $1,500 and would entitle them to a dividend of $180 and a return of 12%, whereas in the levered firm, they would receive a dividend of $195 for a return of 13%. So in this case, you might think, well, the investor would want to encourage the firm to borrow more so that they could get a higher return. Well, one thing we can show is that investors will not be concerned with a firm's capital structure because anything that the firm can do, they can do themselves. Is what we refer to as homemade leverage. So with homemade leverage, well, think about what the firm is doing when it levers up. It's borrowing money to buy back shares. So if an investor held shares in an unlevered firm and would want the firm to borrow in order to increase the return, instead of lobbying the firm to change its capital structure, the investor could simply do that operation themselves. So how would they do that? Well, let's imagine that, if you recall, the unlevered firm had a debt-to-equity ratio of 0, and the levered firm had a debt-to-equity ratio of 0.5. So let's imagine, let's imagine the investor doing the same thing as the firm. So in order for the firm to lever up, they borrow money to buy back shares. So let's imagine this investor borrowing money to buy more shares in the firm. Let's imagine that they borrowed $750 and used that to buy 15 more shares. So now they own 45 shares for a total equity of $2,250, and this would entitle them to a dividend payment of $270. So in the unlevered firm, it's still $6 per share. However, out of this $270, they have to pay some interest on the debt that they owe now. So they're having to pay $75 because we're using an interest rate of 10%, and their payoff ends up being $195, which, as it turns out, is exactly the payoff that they would receive if the firm had levered up and borrowed more money instead of them having to do it themselves. So this is an example of homemade leverage. And this is an argument that we are going to be using throughout an argument that we're going to be using. Oh my God. And this is an argument that we're going to be using throughout this lecture, which is that, yes, while an individual may receive different outcomes depending on the capital structure of a firm, anything that the firm could do, under certain assumptions, the individual investor can also do. If the firm can borrow money to buy more shares, so can the individual, and we've shown that they can replicate exactly the outcome. Okay, so we've seen how an investor who likes the higher return they would get in the levered firm could just replicate that operation by borrowing to buy more shares themselves. Well, as we've seen throughout this class, typically a higher return carries with it additional risk, and perhaps the investor does not want this, right? So let's imagine an alternative scenario where the firm did lever up, but the investor prefers that they hadn't. So what can they do to deal with that? Well, if the investor can replicate leverage by borrowing, well, an investor can also replicate deleveraging by selling some of their shares and then lending it out. So let's imagine them doing that. Let's imagine that the investor in the levered firm is going to sell 10 of their shares. They'll only own 20 shares for 500, and they're going to buy 500 worth of debt. This means that they'll receive 6.5 per share still, so 130 in dividends, and then an additional 50 in interest payments, which will give them a total payoff of 180, which replicates the 12% return in the unlevered firm. So what does this mean? If the firm levered up and the investor preferred that they hadn't, they could replicate the payoff in the unlevered firm. If the firm had not borrowed, but the investor preferred that they had, then they could also replicate that by doing the opposite operation, as we saw in the last slide. So whatever capital structure the firm adopts, the investor can, under certain assumptions, replicate that capital structure by borrowing or lending on their own. This is homemade leverage. So we talked about, well, you can do homemade leverage under certain assumptions. So what kind of assumptions are we talking about? Well, we're going to assume perfect markets. Perfect markets means that everybody is a price taker, nobody is manipulating the market, and it's frictionless, so no transactions costs. You have cash flows are independent of capital structure. So as we saw in the previous example, the total cash flows of the firm are going to be $36,000 regardless of whether it levers up or not. So basically, the capital structure of the firm does not impact its operations in any way. We're going to assume that everybody can borrow and lend at the same rate. So this is a critical assumption for homemade leverage, right? Because in the example that we showed, we're assuming that the investor can borrow and lend at the same 10% rate that the firm does. This, of course, doesn't always work in reality. We're going to assume that everybody has the same information. And we're going to assume there are no taxes. We'll actually think about what happens in the model if we assume that there were taxes a little bit later on. So these are the Modigliani-Miller assumptions. And just like a lot of other models that we've been looking at throughout this course, these sort of reflect the structure of an idealized market, right? Where everything works as it should, and there's no complications like taxes or transactions costs or asymmetric information. And so let's think about the kind of results that we get if we make these assumptions. So Modigliani and Miller showed that if we make this set of relatively strict assumptions, that we get a number of fairly strong results. So the first proposition is that a firm's value is independent of the debt-to-equity ratio. So a firm can lever up as much as it wants without impacting its value. The second proposition is that a firm's cost of capital is also independent of this ratio. The third proposition is called dividend irrelevance, and what it says is that the firm's value is independent of dividend policy. And finally, we have this proposition of investor indifference, which says that investors don't care about a firm's financial policy. So, taking all these together, this is saying quite a lot, right? What all this is basically saying is that capital structure doesn't matter, right? Whether a firm is composed of debt or equity, and in fact, whether it decides to pay out its dividends or to reinvest them, or any other financial decisions that it can make, these ultimately are just window dressing and investors don't care about them. So these seem like pretty strong assertions. Let's think about why Modigliani and Miller made these propositions. Let's look at proposition 1. Let's assume we have an unlevered firm. Unlevered firm is all equity, and then we have a levered firm that consists of some debt and some equity. And let's invoke one of the assumptions, which is that both firms have the same cash flow of X. So how does the value of firm U compare to the value of firm L? Well, if you've been paying attention in this class, you're going to know exactly where we're going to go with this, right? Because, well, we have these two firms that have the same cash flows. They should have the same value. If they don't, well, then there's an arbitrage opportunity. Let's assume that VL is greater than VU. What can you do here? Well, I have two firms that should be worth the same, but the levered firm is worth more. So what does that mean? I want to buy the unlevered firm. I want to sell the levered firm. So I want to buy shares in U. So let's let alpha be my stake. So I'm going to buy an alpha stake in the unlevered firm. And at time t, I'm going to receive cash flows of alpha times x. So alpha is the stake I have in the unlevered firm. And at the same time, I'm going to sell an equivalent stake in firm L. So I'm going to sell alpha times EL. And what is this going to mean for my cash flows? Well, shares in firm L don't pay the same dividend as the shares in firm U, because out of the cash flow of X, it has to pay interest to its debt holders first. So X minus R times DL. R times DL is how much interest it has to pay to its debt holders, and then the remaining amount is allocated towards shareholders. If I'm shorting a stake of alpha, I'm going to have to be paying alpha times that amount. So what you can see here is if I buy shares in U and sell shares in L, well, that doesn't quite achieve this arbitrage portfolio that I wanted, right? And it makes sense why. Because the levered firm is not just its shares. I also have to think about its debt. So rather than just selling shares in L, I want to sell the whole firm. So I want to sell firm L's equity, but I also want to sell firm L's debt, which means that I need to borrow. And how much am I going to borrow? I'm going to borrow alpha DL. This will require me to pay back interest at a rate of R. So in time t, I'm going to be paying back R times alpha times dl. And you can see exactly what happens here. The net payoff is going to be alpha times EL plus DL minus VU. Well, EL plus DL is just VL. And then in the future, well, all of these cancel out. Everything is zero. Why? Well, because I bought a stake in firm U, I sold a stake in firm L. Because these firms have the same cash flows, my future cash flows are zero. But right now, I receive alpha times the difference between VL and VU. If VL was greater than VU, then I have an arbitrage portfolio, I get free money. Of course, if it were the case that VL was less than VU, I take this and I do everything in reverse, right? So I sell shares in U, I buy shares in L, and instead of borrowing, I lend. So this becomes a plus sign, minus sign, minus sign, minus sign, plus sign. This all still zeroes out, but this becomes alpha VU minus VL. Once again, I have an arbitrage portfolio, which is not allowed. So what does that mean? Under the assumptions that I made, and these are fairly strong assumptions, which is that the cash flows don't change and I can borrow and lend at the same rate. I can't have VL be greater or less than VU without creating an arbitrage opportunity. Therefore, it must be the case that the unlevered firm has the same value as a levered firm, which is proposition 1. So far we've been assuming that cash flows were guaranteed. Well, what if the cash flow, instead of being a fixed 36,000, was uncertain? So I have a low, medium, and high possibility. It can either be 24, 36, or 48. So let's first imagine that the firm was unlevered. If the firm is unlevered, it's not paying any interest. So all of this is going to pay a dividend. And with 6,000 shares, that's either going to be 4, 6, or 8 per share, which means the dividend yield is going to be either 8%, 12%, or 16%. Well, let's think about how this changes when we go from the unlevered firm to the levered firm. So remember, the levered firm had 100,000 in debt, which means that it has to pay 10,000 in interest first, irrespective of what its cash flows are, which means that its dividend is either going to be 14, 26, or 38. And per share, remember that the levered firm in this case only has 4,000 shares. It's either going to be 3.5, 6.5, or 9.5. And so the dividend yield in this case would either be 7%, 13%, or 19%. So what do we see here? We see here that assuming the same distribution of cash flows, the levered firm has a higher yield on average, but its yield is also riskier, which is exactly like we would expect. Right? So we've actually seen before how leverage can increase volatility. If you remember those CAPM diagrams, we have our efficient frontier here, and we have our tangency portfolio. Moving up in this direction essentially means that we're borrowing at the risk-free rate in order to buy more of the tangency portfolio, which means that we're increasing our mean return, but also increasing our exposure to risk. So we have shown that when we go from the unlevered firm to the levered firm, that the return on equity increases on average but becomes riskier. So what does this say about what kind of relationship there is between the cost of equity and the debt to equity ratio? So this leads us into Modigliani-Miller proposition 2, which tells us how to think about the return on equity as a function of the debt to equity ratio. So let's start by writing the firm's total return on assets, which is the total cash flow divided by the firm's value. We know we can break up the firm's value into debt and equity. And we can also break up the firm's cash flow into its interest payments, which is the return on debt times the amount of debt, plus the dividend payments, which is the remainder. So therefore, we can think about the return on assets as being a weighted average of the return on debt plus the return on equity, which is going to be the total dividend divided by the value of equity. So this is going to be RE here. So let's look at this equation for a little bit. Let's assume that the return on debt is fixed. And well, we said that the firm's cash flows don't depend on its capital structure, so X is fixed. By proposition 1, the firm's value doesn't depend on its capital structure, so V is also fixed. So RA is fixed. All right, so RA and RD are fixed, but it's in fact the return on equity that's variable. And if we rearrange this equation, we get that the return on equity is equal to RA plus D over E, the debt to equity ratio, times RA minus RD. So typically, the return on debt is going to be lower than the return on assets, which means that the more that the firm levers up, the more debt it takes on, the higher the return on equity is going to be. So let's think a little bit about what this equation actually means. So when we think about this equation, well, let's think about this idea that typically debt is considered to be safer than equity, so it's less risky and has a lower return. So what this equation means, therefore, is that as the firm is shifting more of its assets away from equity and into debt, so as the firm levers up, it's basically splitting off more of its value into the safer debt. However, the firm's cash flows and its return on assets doesn't change, right? Because the firm's operations are not affected by its capital structure. So by pushing more of its assets into debt, this changes the quality of its remaining equity. Its remaining equity, because the value of the firm doesn't change and the riskiness of the firm overall doesn't change, its remaining equity therefore becomes riskier. And we know what happens when something becomes riskier. It's going to require a higher return to compensate. So this is why the return on equity is going to increase as the firm's debt to equity ratio increases. So we can see in this picture that keeping the firm's return on assets constant, we can go from a case where we have all the way to the left an unlevered firm where the return on equity is just equal to the return on assets because it doesn't have any debt, and the more debt it takes on, the more risky the remaining equity becomes, and therefore the higher return it has to offer. So one of the assumptions that Modigliani and Miller made was that there were no taxes, but of course, in reality, there are taxes. So how do taxes change this calculation? Well, specifically, taxes matter because interest payments are tax deductible, but dividend payments are not. So if I have tau being the corporate tax rate, and I have the same cash flows, well, X is going to be equal to the interest payments plus the dividend payments. But these will be taxed, but these will not be, which means that my after-tax cash flow, this is not going to change, but I'm only going to get 1 minus tau times the dividend payment. So the after-tax cash flow can be written as tau RDD plus 1 minus tau times X. So what does that mean? That means that leverage creates additional cash flows because some of them are going to be sheltered from taxes. This means that taking on more debt creates what we call a tax shield. So if I look at the value of a levered firm, it's going to equal the interest payments divided by the return on debt. So the debt is not touched. But if I look on the equity side, dividend payments will be taxed at a rate of tau, which means that I'm going to create a tax shield that's proportional to the amount of debt in the firm. So what's the upshot of all this? The upshot of all this is that in a world with taxes, because there are tax advantages for debt, leverage creates an additional value which equals the tax rate times the amount of debt that you take on over and above the value of an unlevered firm. So there are incentives for a firm to take on more debt because of this tax shield. So if you will recall, without taxes, the return on assets was also the weighted average cost of capital, which is just the weighted average return depending on how much of the firm is debt and equity. And in a no-tax world, the weighted average cost of capital is always going to be fixed. With taxes, the overall return on assets, remember the overall return on assets reflects the firm's ability to generate income, and we're not assuming that that changes. So RA stays fixed. But now the weighted average cost of capital is going to be 1 minus tau times RD times the proportion of the firm that's debt plus RE times E over VL. So what you can see is that because there is a tax advantage to using debt, debt is going to become cheaper, and therefore the more debt that the firm takes on, the lower its weighted average cost of capital. So if we look at this graph, we can see the return on assets stays fixed. So the company's ability to generate income stays fixed, but the more debt it takes on, the lower its weighted average cost of capital, and the lower the weighted average cost of capital, the higher the firm's value is going to be. Let's see how this tax shield would work in the example we've been talking about throughout this lecture. So we have an unlevered firm and a levered firm. They both have cash flows of $36,000. The unlevered firm has no debt, so it doesn't have to pay any interest. The levered firm has to pay interest of $10,000, 10% on debt of $100,000. So the pre-tax dividend is $36,000 for the unlevered firm, $26,000 for the levered firm. Now, the dividends are not tax exempt, so they'll be taxed at 35%. So the after-tax dividend is going to be 23.4 for the unlevered firm and 16.9 for the levered firm. So we're going to use these to get the firm's value of equity. Well, if you recall, the return on equity for the unlevered firm was 12% and it was 13% for the levered firm. So if we divide this by 12%, we get equity of $195,000 here, and equity of $130,000 here. So if you want to think about this another way, this is 300,000 times 1 minus tau. This is 200,000 times 1 minus tau. So the value of equity is reduced by the tax rate. Because the unlevered firm has no debt, its total value is $195,000, whereas the levered firm has debt of $100,000, which is not affected by taxes. Therefore, it has a total value of $230,000, which is higher than the value of the unlevered firm by $35,000, which is the value of the tax shield, which once again is equal to the tax rate times the total amount of debt in the levered firm. Another way of thinking about the tax shield is thinking about it in terms of the weighted average cost of capital. So for the unlevered firm, that's just going to be the same 12% we've been using this whole time. For the levered firm, the weighted average cost of capital is going to be 1 minus tau, so 1 minus 35% times the return on debt, which is 10%, times the fraction of the firm that is debt, which is 100,000 out of 230,000, plus the return on equity, which for the levered firm is 13%, times the fraction of that firm, which is equity, which is 130 out of 230, and that gives us about 10.17%. If I then discount the after-tax cash flows, 1 minus tau times x, by the weighted average cost of capital, I get the levered firm's value of $230,000, which once again gives me the same tax shield of $35,000. So we can see that there's a tax advantage to borrowing because interest payments are not taxed, whereas dividend payments are. So, given what we've just said about the tax shield, does this mean that firms should just borrow as much as possible? Because, well, levering up reduces the amount of tax you have to pay and therefore makes the firm more valuable, which is good, right? Which means that firms should be as highly leveraged as possible, right? Well, not quite. Because while there is a tax advantage to taking on more debt, there's also costs associated with taking on more debt, and these are a little bit more difficult to measure than the tax shield. Why? Well, the more highly leveraged a firm is, the more likely it is to default. And when a firm defaults, well, there's going to be bankruptcy costs associated with that. But on top of that, being too highly leveraged, being at too high risk of default, is also going to impose certain intangible costs on a firm as well, right? Firms that borrow too much are typically seen as unreliable, not as trustworthy, and the threat of an impending bankruptcy can damage a firm's operations because you think about everybody working at the company is afraid that the firm could go under at any moment. They're not going to be as productive. Now, this sort of goes against the assumption that we made before that leverage doesn't affect a firm's cash flows, but that was just a simplifying assumption. In practice, taking on too much debt certainly can affect your cash flows if it's impacting the firm's productivity. So when a firm is deciding how much to lever up, there's this trade-off it has to consider. Yes, there is a tax advantage to using debt because it creates a tax shield. But on the other hand, there's also these distress costs that need to be taken into account, which are a little bit more difficult to measure, which means that it's not so easy to determine what a firm's optimal debt-to-equity ratio is. So far we've assumed that all of the earnings that a firm makes are either going to be paid out as interest to the debt holders or as dividends to shareholders. But of course, this isn't always the case. Firms are typically going to retain some percentage of their earnings in order to reinvest into certain projects. So rather than just taking their earnings, paying out the interest that they owe, and then paying out the remainder to shareholders, they're typically going to announce a dividend ahead of time and pay that irrespective of where their earnings actually end up. And this can be a little bit odd, but it makes sense if you think about the signaling value. Because if a firm were to cut its dividend in response to getting lower earnings than expected, this sends a very strongly negative signal, right? If you're cutting your dividend, that means that the bad quarter you just had is expected to be the new normal, and that sends a very weak signal to your investors, so you don't really want to do this. At the same time, if you have a good quarter, you don't want to suddenly raise dividends either, because you don't want to raise investors' expectations that your earnings are always going to be higher from here on out. So rather than letting your dividend payouts fluctuate with your earnings, typically firms are going to try and set their dividend at some kind of long-run sustainable level. And if they happen to have some type of earnings surprise, for example, let's say they had excess earnings this quarter, rather than increasing their dividend permanently, they're more likely to pay this out, if they wanted to pay it out, in the form of a stock buyback. So let's think about what Modigliani and Miller have to say about dividends. The important thing to remember here is that investment and financing decisions are going to be made independently. This means that if a firm is going to be reinvesting its earnings into certain projects, those investment decisions are made entirely on the basis of whether those projects had sufficient NPV to justify their investment. So a firm is not going to find places to invest its earnings just because it has the money. The investment decisions are made irrespective of how the firm is going to finance those investments. So let's look at an example. Let's imagine we had a firm, and the firm has assets of 3,000 with 100 shares outstanding, and that it has earnings of 1,000. And it has the opportunity to invest this 1,000 in a project that has an NPV of 1,000. So it has assets of 3,000, it has 1,000 in earnings that it could reinvest, and if it did so, it would generate another 1,000 in NPV, which means that the total firm's value is 5,000. So if it were to retain this 1,000 in cash to invest in the project, it wouldn't be able to pay out a dividend. With 100 shares outstanding, this would mean the shares are worth 50, and it's not issuing any new shares. Well, let's think about the alternative. The alternative is not to not invest in the project. The fact that the project has a positive NPV means that the firm is going to invest in the project whether it pays a dividend or not. So let's think about an alternative scenario. Let's think about a scenario where the firm insists on paying out this 1,000 as a dividend. So it's paying a dividend of 10 to its shareholders. However, this does not mean it's not going to do the project. It wants to do the project because it has a positive NPV, not because it has the money on hand to do it. So even if it ends up paying out all of its earnings as a dividend, it's still going to want to do the project anyway because it has positive NPV. Well, how else can we come up with the money to pay for the project? Let's think about issuing new shares. So it needs to issue enough shares to raise this $1,000 that it needs. However, when it issues new shares, its value stays the same, right? Issuing new shares is not going to increase the firm's value, which means that it's going to reduce the price of shares. By how much? Well, because the firm's value stays the same, whether it retains its earnings to pay for the project or pays out a dividend, the total payoff to shareholders must be the same. So in the state where the firm retains its earnings, the shareholders don't get a dividend, but their shares are worth 50. In the state where the shareholders are getting paid a dividend, they get a dividend of 10, which means that their shares are only going to be worth 40. And if the shares are only going to be worth 40, in order to raise $1,000, the firm needs to sell 25 new shares. And what you can see is that there's 100 shares, each worth 50 here. Here I have 125 shares now. They're each worth 40. The firm's value stays the same. So we can see here that the payoff to shareholders is the same whether the firm decided to retain the earnings to pay for the project or whether it paid out the dividend and then paid for the project by issuing new shares. However, let's imagine that shareholders wanted the dividend. So, if the firm chose not to pay the dividend, but shareholders wanted a dividend, how could they replicate that? Well, they could replicate a dividend by selling some proportion of their shares to get a payoff now, and so they'll have less equity, but they'll get a payoff today as if they had gotten a dividend. So just like with the homemade leverage example, if shareholders do not like the firm's payout policy, they can replicate their desired payout policy by selling shares on their own. And remember, none of this has any effect on whether the firm is undertaking the project or not. Whether the firm undertakes the project or not depends entirely on the project's net present value, on the merits of the project, right? The ability to finance the project has no bearing on whether it's undertaken. Now let's think about an alternative scenario. In the last example, we considered a project with a positive NPV of 1,000. So whether a firm was going to finance it with the cash they had on hand, or whether they were going to raise money by issuing new shares, they were going to do the project. But now let's imagine that the project NPV is actually minus 500. What this means is that the firm is now not going to do the project. So it still has 3,000 in assets. It has 1,000 in earnings from this period. So if it pays out the dividend, each investor will receive 10 and the share price will be 30. But let's say it didn't want to pay the dividend. What could it do instead? Well, what it's not going to do is invest in the project. Once again, investing in the project is a bad idea even though the firm has the money to do so. So instead, what it could do is use this 1,000 to buy back shares. So rather than paying a dividend, it's going to buy back some of its shares from investors. So what's the buyback price going to be? Well, once again, we want to use the principle that the payoff to shareholders should be the same, right? Whether the firm is paying a dividend or buying back shares, that's not affecting the value of the firm at all. So if it's not paying a dividend, the share price should be 40. And how many shares can a firm buy back? At a price of 40, it can buy back 25 shares. So remember, there were 100 shares here. So we can either have 100 shares that are each worth 30, or I can have 75 remaining shares that are now each worth 40. In either case, the payoff to shareholders will be the same. So now let's look at the last of those Modigliani-Miller propositions, which was investor indifference. So we showed that under certain assumptions, investors don't care about capital structure. Investors can replicate their desired capital structure by borrowing or lending on their own. And this relied on the assumption that they could borrow and lend at the same rate as the firm. Investors also don't have any reason to care about a firm's payout policy, right? Because they can buy or sell some of their own shares to imitate the payoff from a dividend or a buyback, right? So, for example, if a firm is paying out a dividend and you didn't want it to, you could use your dividend to buy more shares. If the firm did not pay a dividend and you wanted it to, you can sell some of your shares to replicate a dividend. So once again, the investor can take actions on their own to mimic the desired policy on the part of the firm, which means that, once again, under certain assumptions, what the firm decides doesn't really matter. So what does matter? What matters are a firm's investment decisions, what the firm is actually doing to create value. And these have nothing to do with its capital structure or its payout policy. They only depend on how lucrative those investment opportunities are as measured by their NPV. So let's think a little bit about the applicability of the Modigliani-Miller propositions in the real world. And we said that the assumptions that we have to make to get to these results are pretty strong. So let's think about what happens when some of these assumptions are relaxed. We already talked about how with taxes, there's an advantage of using debt because debt creates a tax shield. However, the tax advantages of debt have to be balanced against the distress costs of borrowing too much. We also talked about how a lot of the Modigliani-Miller results rely on the investor doing on their own what they wanted the firm to do, right? If the firm is not borrowing enough, well, I'm going to borrow. If the firm is not paying out a dividend, I'm going to create my own dividend by selling some of my shares. Well, this is problematic in a world with transactions costs because for you to do something like this is going to be costly, especially if you're trying to mimic every single action you wish the firm would take. Typically, you want this to happen at the firm level because the firm is not going to incur as many transaction costs, presumably, as an individual investor would. And finally, we have to think about the role of asymmetric information, right? Which is that in the Modigliani-Miller world, firms can change their payout policy and they can change their capital structure, and people will not read any kind of motivations or implications from these actions. Of course, this is certainly not true in the real world. Everything firms do is scrutinized. When firms change their dividend, investors are going to read things into this, and this is going to have effects on the firm's value and its share price and so on beyond what the direct impact of those policies would have. So this is also something we need to consider when we want to think about the applicability of the Modigliani-Miller propositions. So just like a lot of things we studied in this class, the Modigliani-Miller propositions are a set of results that we get in an ideal market with very strict assumptions that we don't always see in the real world. Now, the fact that these assumptions are violated in reality doesn't mean that the Modigliani-Miller propositions are not worth studying. They give us a lot of insights, but we also need to be careful when we try to use them because they rely on assumptions that we don't usually see real-world markets adhering to.